Podcast is now starting. All attendees are in listen-only mode.
Well, hello everyone, and hope you're all having a great Wednesday. My name is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. I encourage you to visit TradersCoach.com at the website and check out all our free info there. We've got a great educational event for you this evening, and just a few administrational items before we do get started. For those of you that are not familiar with the GoToWebinar platform, I'd like to show you a few of the features you'll be using tonight during the broadcast. The first item I'd like you to take a look at is the questions area on your control panel. And to test that feature and to let me know that you can hear me and see the webinar screen, how about if everybody just types in the name of their city or the country or wherever you're watching us from? That'll let me know that everything's working. So while you're all typing in your cities and countries, you may also want to unlock this questions panel by clicking on the arrow icon to the right of the questions area. This is the area where you will be communicating with our speaker tonight, and you can type questions for him there. Your questions will be answered throughout the event. All right, well, we've got folks from all around the world. We've got Larry from Olympia, Washington. Sounds like you live in Dean's neck of the woods. And we've got, let's see, William from Irvine, California. William's in our neck of the woods. We've also got Al from Knoxville, Tennessee, and folks from all around the world. Well, great to see you all here. Glad to see that that's working. And the next area I'd like you to take a look at is the chat area. And I just posted a link in the chat area, and that is the TradersCoach.com website link. And if you could, in the questions area, let me know if you can see that link, that'd be great. Just give me a Y or a yes. I encourage you to visit us at TradersCoach.com online. Lots of free, cool information there, and come by and visit. So tonight we have Dean Jenkins of Follow Me Trades with us tonight. And Dean's terrific. We love Dean. He's, of course, one of the family, and we've had him on Wednesday Night Live many times. Tonight, Dean will be talking about Be the House. Put probability and math on your side for consistent profits. Dean's founder of FollowMeTrades.com and has over 20 years of investing and trading experience. He makes his living trading the financial markets, and he's an expert in technical analysis, money management, Elliott Wave, and in implementing all of the TradersCoach.com software tools. With that, Dean, I think I'm going to turn it over to you, and thanks so much for being here.
All right, thank you, Jean, for that great introduction and for inviting me back here to Wednesday Night Live. So good evening, traders. It is awesome to be here. It was fun seeing all the places you guys are calling in from. And I think Chandra gets the distance record with Jakarta. That's awesome. So I'm really excited. This is new material that I'm going to be presenting tonight, and it's really talking more than specific trade setups. It's talking about things that apply no matter what trading system or indicator set or whatever you use. But it's the math behind trading, the math behind profitable trading. And I say, be the house, right? Let's have an edge. We're going to talk just a little bit about casinos and compare that to trading. So before we get started, just a quick disclaimer as always that we're going to look at a few live charts. I'm going to share some of my favorite trades with you, and I'll be offered to look at any charts that you're interested in. But I'm not a financial planner. That's a whole different profession. I'm a trader. And so I'll share what I'm doing, but whether anybody places an order, takes a trade, each person has to make their own decision about that. Only you know what's best for you, what meets your criteria, what's appropriate for your risk tolerance, all those things. So what I'm presenting is for information and education only. I'm not giving financial advice. Okay. Yeah, we're just showing the slides. There's no camera on here. So I think I have learned, I am convinced that to be consistently profitable as a trader, you've got to have these three things, that they are just absolutely essential. First, you got to have great trade setups. You have to have a high probability outcome, an edge in your trading, right? You have to have great reward to risk ratios, meaning that the trades you take have the potential to win more money if they win than they would lose, than money they would lose if the trade loses. You got to have great risk management, which controls that loss. And then you have to have a black and white, well-defined way of managing a trade. And that's different than risk management. Risk management is controlling how much you can lose. Trade management is the moves you're going to make once you're in a trade. If you don't have that mapped out ahead of time, good chance are that you'll be making emotional decisions and maybe not the best decisions as you go about it. So I'm convinced that these three things, regardless of the trading systems, this transcends, any indicator set or any instrument, that these things have to be, present, whether you're trading futures or Forex or stock or options or any of that. But the title here was, how to be the house, let's have an edge. So let's talk about casinos. So here's some folks at the craps table, and they're having fun, right? They're rolling the dice there. It looks like they must be winning because they're all smiling. There's alcohol involved, right? And they're just having a great time. And, I think if you're going to the casino, you should probably view it as entertainment, not as anything else. But so these people are gambling, right? Looks like they're having a great time. But here's a question. Are the casino's owners, are they gambling? Absolutely not. The people on this page, these folks, they're gambling, right? The folks upstairs looking at the cameras with the green eye shades on, they are not gambling. And the reason they're not gambling is they are absolutely ensuring control of two critical variables on every single game on the casino floor. They're controlling probability, the outcome. They're going to make sure that they have a statistical probable edge in the outcome over time of what's going on the floor, and they control their risk, right? They control their risk, and it's as traders, we do, to be the house and to be consistently profitable, we need to do the same things. So consider roulette. This is a really simple game, right? Everybody's familiar with a roulette wheel, probably. It looks like that, right? So it seems just like painfully simple that there's numbers. They're 1 to 36. Half the numbers are black, half the numbers are red. So there's even odds. If you bet that the ball after the spin is going to land on either a red spot or a black spot, or it's going to land on an even or odd spot, right? There's a 50-50 chance of that. And there's a 1-to-1 payout at the roulette table. Okay. So if you bet $10 and if you win, you win $10. You get $20 back, your $10 bet, and then you get a $10 payout. Okay, so it pays out 1-to-1. It just seems simple, right? But here's what a roulette wheel looks like, an American style roulette wheel. And if you notice, we've got all our red and black spots. But what's up with these green spots? There's a green 0 and there is a green 00. What is up with that? Well, what's up with that? The green spots, 0 and 00, they change the odds from 50-50 to 47.5% win. So as a player, if you're betting on an even number or an odd number or a red or a black, you have a 47.5% probability to win every single spin. That's different than 50-50. The casino has a 52.5% chance of winning. They have a 2.5% edge in the game of roulette, and that is enough. And they make all their profit on that 2.5% edge. And they know that over thousands of spins of the roulette wheel, that they're going to win 52.5% of the time. They know that the outcome is normally distributed data and that they will win more than they lose just a little bit, and that would be enough for them to be wildly profitable. How cool is that? So wouldn't you like to have some kind of edge in your trading, knowing with certainty, the way the owners of casinos do, that over time, you're going to be profitable. Won't win every spin, won't win every trade, but you will be profitable. That would be comforting, and that would take the pressure off. All you got to do is follow your program, right? Follow your trade rules, and whether any individual trade wins or loses doesn't ultimately matter, because if you were in the situation the casinos are in, you would know. There's a mathematical certainty that this is going to be the outcome, right? And casinos ensure this. They make sure this happens via two mechanisms. The first is they have a probability edge. They put those doggone green spots on there to absolutely make sure they have an edge. And then they control risk, right? They control risk. So probability is controlled via the two green spots, tilting the odds just a little bit in their favor, 2.5%. And they control the risk via table limits. So you can't walk into a casino and put $1 million bet on a black spot, because that would be an unacceptable loss for them, because there's a 47.5% chance that you would hit that, right? And that would be a tremendous setback for them. So they put a table limit, and they go, depending on the casino, depending on the table, they go, most you can bet's $100 per bet, or 200, or whatever the limit is in the establishment, right? But they limit it, right? And in that way, if they get a string of losses, and you have a string of wins that are within the normal distribution of data, they're not gonna lose a ton of money, and they just know, again, over tens of thousands of spins, they're going to be making money. And what they really want you to do is stay there at the table and spin that wheel over and over and over, and they entice you to do that with comps and rooms and drinks and whatever they can do to make you stay there and spin that wheel, you and the 1,000 other people, because they know there's a mathematical certainty that they will win. And the more you spin, the more they win. There's a good bumper sticker, right? The more you spend, the more they win. So why not be the house? Why not be in that situation as traders, right? So I think to be consistently profitable, you're going to need three things. The first thing you're going to need is great trade setups. You're going to need a trade setup that gives you a high probability outcome, greater than 50%. And you need setups and trade parameters that give you a good reward to risk ratio. So you can go a step further. You can go a step beyond what the casinos do. Because on the roulette wheel, all they're looking for is a 1-to-1 payout. You bet $10, 52.5% of the time you lose, they win $10. As traders, we can tilt that and go, no, I'd like to win $12 or $15 for every $10 I lose. We can do that by only taking trades that have a great reward to risk ratio, that have a potential to make more than you would lose. So let's look at a live chart and demonstrate this concept, right? Enough PowerPoint. Let's look at some charts, traders. So I'm going to show you a great trade setup. It's a trade we just got into recently. And I'm going to drag it over here. Come on. There we go. TradeStation was giving me a little heart check. It's a little slow. Okay, here's Halliburton. So I know lots of you are, following along with Bennett's teaching about Elliott wave and the arc system. Many of you, I invited you here, and you're following along with what I'm doing. What Bennett and I do are very, very similar. So some of you are already looking at Halliburton and going, yep, wow, wave 5, beautiful setup. And it is a beautiful setup, right? So this is the same kind of thing that Bennett looks for and I look for. So what we've got here is an initial impulsive wave, this big move here from the beginning of 2016 up to early 2017. This is a Elliott wave 3, big impulsive move, hard to miss. Okay, we've got a retracement down here. This is a clear Elliott wave 4. So we had the big move, then we had a correction. And we can use Fibonacci retracement tools to measure that. And we can see that, boy, that was a perfect retracement. So these blue lines, 38.2 to 61.8 Fibonacci retracement, that retracement was right there, right where we want it to be. And now We see it had a complex correction for a while, but now it's breaking out. And we see green PTF. We see the owl going up. It's green. It's even such a strong move that the owl is calling this wave 3, but we can look and see that it's not. It's not wave 3. And it's not looking back. It only looks back 144 price bars. But what we see is price breaking out. We got a MP, green MP here, green MP here, and now finally a major pyramid here, right? And I actually took this trade. I'm in this trade, and so are my people following my advisory service. So what's the price target? We just use Fibonacci extensions to project where wave 5 has a high probability, right? With a pattern this clear, right? Once you've looked at thousands of charts like this and you've got the art system backing you up, the probability of this stock going up into the wave 5 target zone, which is those two green lines, it's 5708 to 6888. The probability is very high, right? It's higher than 50, that is for sure. It's probably higher than 70%, just a guess. Okay. Now, when I go to take a trade, there's a couple things I measure. Remember, I said we can go a step beyond what the casinos do, because not only can we ensure that we're taking high probability setups, we can put probability on our side, we can control risk, and we can go for a better than one-to-one payout. We can go for an increased payout. Okay. So clearly we put our stop at the bottom of this pyramid. That totally makes sense, right? Let's say we were going to take this trade right now, today's close. So there's a little green price bar. So if we're going to take the trade at today's close, right? Now we've got a price target zone between these green lines. So let's put our target in the middle, okay? I got in this trade way back here, right, and published it. I typically use my target as the bottom of the price target zone, and so it's actually a little bit late to get into this trade, but it still looks pretty good. Everything's green, right? But let's assume the target is in the middle of the overall price target zone. What we can see is the distance between the entry price and the stop price is our risk. The distance between our entry price and our target price is our reward, right? That's how much we'll win. Well, this is like twice. This is like double the risk, right? The reward is like double the risk. That is the exact situation that we want. That's how we can, again, even go one step farther than the casinos in not only having a high probability outcome, controlling the downside, but we can make sure that if we do win, it's going to be bigger than if we lose. And I'm going to be showing a model here in a minute that just shows how critical that is. All right. Now, the way we control risk, we look at this entry price and this stop price, and we use a formula, right, to figure out. Here's Elliott wave, right? We go, yeah. So you got to determine how much you're willing to lose on a given trade. And the casinos have done that. They set a table limit, right? And this has to be a pain-free level. So the amount you lose per trade has to be an amount that would not be a big setback where you would stop trading, or if it happened a couple times, you would have to stop trading, or it would cause you grief, right? And maybe to stop trading or to go into some kind of negative psychology, trading psychology things where, you feel remorse or anger, right? It's got to be a pain-free level where you go, yeah, it lost. Okay, move on, right? I use 2%. So 2% is, for me, a pain-free level, and it's also a good starting level for most people. So that means if you got a $50,000 account, 2% of that is $1,000. So if you set your stop correctly and your position size correctly, and the trade fails, you'll lose no more than $1,000. Okay, so the way you calculate that, and this is what Bennett teaches. He sells a really cool risk calculator tool too, a nice little piece of software. But the position size is determined. You take the entry price, you subtract the stop price. That gives you the risk, right? If you're entering at $10 and your stop is at $8, then the difference is 2. Your risk is $2 per share. you divide that into 2% of your account. So if it's a $100,000 account, it's $2,000, right? You divide the difference between your stop entry into that risk amount. It gives you how many shares to buy, how many shares to trade with. That's really, really simple arithmetic. This is arithmetic you had to master before you could go to junior high, right? So nothing too complicated about it. But what that does is so many traders make a mistake of taking a fixed trade size and then say, I trade 100 shares per trade, or I trade 10,000 shares per trade, and then they also use a what I would call an arbitrary stop level. They go, well, if I lose 5%, I'm going to get out of the trade, or if I lose $500, I'm going to get out of the trade. Those are arbitrary levels because 5% move may be absolutely within the expected volatility, the average true range of the trade. So I think using a tool like the ART system, the pyramids, to put your stop at a key support level according to price action, and then determining your position size from that is the correct way to do it. I've had that proven to me over and over and over again, right? So I'm a big advocate of it. Bennett taught me that, and I've seen lots of other approaches, tried lots of other approaches. I think this is the best, right, for consistent profitability. Okay, so to be a consistently profitable trader, you got to have great trade setups, high probability outcomes. We talked about a trade setup here. You got to have risk management of controlling the losses, right? Let's talk about. I'd like to show you a statistical model that I built. I just love Excel. I am an Excel geek. I just admit it. Okay, but what I did was I took my actual trading results. So here's the results from my trading room for last year. Did pretty good in the trading room. We started on this method in about April. So from April to the end of the year, we took 66 trades. Only won 48% of them, but it was okay because our payout ratio was 1.8. We ended up with a 35% profit, increased the account by 35%. Well, that's not too bad. And then on my other service, so that's my trading room. On my other service, I put up here the results I get year after year after year. There's complete transparency, and you can see any of these buttons you can click in and go see the details of every trade I took. Like last year, the stock pick service, we took 60 trades, right? And we were profitable. Very nice. 24.23% profitable. So it worked out really good, pretty good. I'd like the win rate to be higher. It was a tough year. You look back and you go, oh, it just went straight up, but that was never clear along the way. Still isn't, right? And so we're also, being careful. But what I did was took these results, my long-term results, and plugged them into a statistical model. And just because sometimes, in a shorter term, a shorter number of trades, it doesn't match what your longer-term results are because there's normal variation. The data and the probabilities are normally distributed, right? So what I did was I just built this model. Here's the assumption. It's a $50,000 account. We're not going to risk any more than 2%, which I definitely recommend. And we're going to have, so if a trade loses, it's going to have a random loss between $100 and $1,000, with 1,000 being the max. And that's pretty consistent. That's pretty realistic for the losing trades we did have. You can see here L, right? There's a variety of losing sizes, some very small, $88, $19, and some up to $1,000. So that's realistic data, right? Random loss between $100 and $1,000 if the trade loses. And then every trade has a 60% chance of winning. That's my long-term running win rate over multiple years. And we said a random win is between $100 and $31. So if the trade wins, the amount it wins is going to be a random amount between $100 and $3,100, which again is consistent with the results I see. You can see some winners, 2,600, 2,600, 2,500. Some are, $3, 3,700. So I just kind of normalize that. So, it's 100 to 3,100. Okay. And what I do is run 50 trades here in this model. And every trade, here's the trades down here. And I just use the random function in Excel. So it's a 60% chance of winning. So if this number is zero point 0.4 or less, it's a loser. The random generator generates from 0 to 1, right, in Excel. So if it's 0.4 or lower, it's a loser. If it's 0.41 or higher, it's a winner, which gives us a 60% chance of winning or losing. And then I can just cycle this sheet, right? All I do is press F9 and it'll run this. And it says, okay, if it's a winner, if it's a loser, then it's going to pick a random loss between $100 and $1,000 and go, that's your loss on the trade. If it's a winner, it's a random win between $100 and $3,100, right? Because there is some randomness to it. We have a probability on our side, right? But we don't know exactly. The outcome of any trade is ultimately unknown until you close it. All right. So that's how this model is built. And what I like is the way it demonstrates the criticality of taking bigger, having a good reward to risk ratio and of controlling the max loss, right? Just like the casinos do. If we can actually live out this idea of not losing more than 2% of our account, then watch what happens as I cycle this thing. Each time I press a button, it's simulating 50 trades with a 60% chance of winning, and again a random amount of losing between 100 and 1,000 or winning between 100 and 3,100. Every time I press the trade, this red line is 0, and what it's doing, this is a weighted display of the losses. So we put the losers into buckets between 1,000 and 850, 850 to 700, 700, blah 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 blah. So if there was 5 losers in that bucket between 800 and 1,000, then that bar is going to be $5,000, and these are weighted the same way for the wins. So every time I push the bar, right, it's a new set of 50 trades. And what's super critical here is you say, hey, I just pressed the button and it's a 40% win ratio. And you say, well, I thought it was a 60% chance. It is a 60% chance over a much, much, much larger sample, right? But as we take a few trades, there can be normally distributed data, normal variation within that. But what's key here is well, I just ran 50 trades and it was kind of lousy. It only had 40% payout, 40% win ratio. Yeah, but it still had a two to one payout ratio, and it still made $1,400 on a $50,000 account. So the model can do better, but if you notice, it doesn't matter how many times I press this button, how many trades I take. Over 50 trades, the win ratio, the payout ratio, the amount we win has quite a bit of variance. But what's one thing that never happens? Go ahead and type it in. What's one thing you've never seen happen in this model? And I'll just keep pushing the button because it's fun. Anybody take a guess? We've never seen it. We've never seen a net loss across the 50 trades. We've never seen a net loss. Now, one of the things that some traders do, and particularly newer traders, that I think is a huge mistake. They'll get into a trade like Halliburton. So we're in this trade. We took our entry right above this pyramid, so at about $50, right? It's jumped up. So now it's up at $52. And depending on the position size, some traders are, wow, I made profit, right? I made 4% profit from 50 to 52. And they'll take the profit and close the trade. What does that do to this model? It's devastating. It's absolutely devastating. What if we capped the max win on this model at $1,000? So the amount we could lose is equal to the amount we win. Now, even if we have a 60% win ratio, now I'm going to cycle this saying, oh, every once in a while out of 50 trades, we have a net loss. We also have very small wins. Because the wins are equal to the loss, and the amount we win, right, even though we may have a long-term 60% win rate, in a smaller sense, in a smaller sample size, we may not have 60%, right? The sample's just not big enough, right? So we we win a lot less, and sometimes we lose by getting out of the trade too soon and not realizing that critical parameter of payout ratio, of having the trades be bigger than the losers, having the winners be bigger than the losers, right? So let's put that back where it belongs, right? Because that's an unhappy thing. And I wanted to make sure, so I wanted to make sure last night, I go, you know, the variation was pretty big on this model, right? The variation of win rate with a 50 sample, right? There's 64, 56, 70, 50, 60, 62, 64, right? There's a lot of variations. I go, man, I want to make sure this model's working. And so I ran 300 tests last night, and it's perfect, right? The median of the data from 300 tests is 61, and it's absolutely normally distributed data, right? Anybody who's had any statistics knows that that is absolutely perfectly normally distributed data. So that model is working perfectly. So I just think that's the coolest thing ever because I'm an Excel geek. But I think there's some valuable points to take away from that. It just helps to drive home maybe in a visual way how critical it is, right? How critical it is to control risk, to have a statistical edge, and to make sure that the trades you take have the potential to win more than they would lose. I can even, with these parameters, right, with the winners potentially being 3 times bigger than the losers, we could set this at 50%, and we're still going to be profitable, right? Because our edge now comes in the payout. I'm still running it, right? It still won't go negative there, right? Over time, it will have been less, right? A little bit less profitable. And the other thing, what if we weren't using correct risk control? What if we let this, let our losses be big? Now, some of those losses are going to be off the chart here, but occasionally we're going to see a negative outcome here. Yep. How about that? Negative outcomes, net negative outcomes over a large number of trades, not so pleasant. But the other thing that we can take away from a model like this, we go, this is a 50 trade sample. So it came in at a 50% win rate, somewhat under the typical long-term thing. It's okay, it had a huge payout ratio. But look, 3 losers in a row, 2 losers in a row. Sometimes we get a big string. This one didn't really happen. We had 3. There's 4. So what if you're in these trades, right? You trade this trade, and it loses. And you take this trade, oh, what? Wow, no. Right? It can get discouraging. It can. And that's why it's so important to have rules, to have tested them and done some kind of modeling and proof on them, or to be, following someone who has, following along, getting a little guidance, right? There's 4 losers in a row. That can be incredibly discouraging, right? And you start second guessing, and what you don't want to do is to let something like, by the time you get to the 3rd loser here, to go, okay, I'm going to start twisting the knobs, right? I either got to, don't get out when it stops because, you've all seen it, right? We put in a well thought out stop, goes down, hits it, and then turns around and goes back where you thought it was going to go. Don't let one trade like that change your trade plan, right? Analyze dozens or hundreds of trades before you start thinking about changing your trade plan. So, Joseph, your experience 50K is insufficient, 100K is marginal. I think I would disagree. I think you can trade profitably with less than that. I think you can trade profitably with as little as 10K. The key to that and trading smaller accounts is it's better if you're in a position than to leave the money there and let it grow, right? Because if you're trading with a $10,000 account and you got to take distributions out of it to pay your bills, right? If you get into this situation where you get 3 or 4 losers in a row and you take a distribution, now you're below critical mass on your capital. So with smaller accounts, I think it's important that you can leave that in and let it grow exponentially. And if you do and you follow the rules, it should. Okay. Where are we in the presentation? So we looked at some real results, right? Trade management. So here's the other part of it. I talked about what happens if you jump out too soon. What you do is you cap your winners, and it skews the statistics for your payout ratio, and ultimately can result in, a lot less wins and potentially net losses over time. So that's not good. We're not here for net losses. That's not the goal, right? But you can still get into a great setup. You can have great risk management. You can still lose money if you don't manage the trade correctly. And so great trade management includes taking profit at the right times. I use the 1B, 2B bars and crossing key Fibonacci lines where we scale out, take a third. Next time, take another third. Let the final third run all the way until the trend ends, right? And get stopped out. You can add to the position strategically. You can scale into a position. And I don't mean doubling down. Doubling down is a strategy that some traders use if they get into a position and it goes against them, but they still think it has a good chance of winning, they will add to the position with the idea being that it will reduce their average cost per share, right? And then when it does win, they'll make more money. Well, that's true if it wins. What's the problem with that strategy if it loses? You're going to lose more, right? You just increased your risk. And if you took the correct position size initially, right, and then you add to that risk, now you have too much risk. Not a good strategy. So scaling in, there's three rules for scaling in. First, the trade's got to be in profit. Second, you have to move your stop, right? You have to have a less risk on the initial trade, because when you move your stop, then the amount you would lose if it hits the stop is less. And you have to have room left in the trade, right? It's got to have sufficient room left to the target. And then you can calculate, right? If I add shares, but still maintain my 2% risk, that would tell you how many shares you could go add, right? And you could add to the position, and if it wins, it would be a bigger payout. And if it loses, the worst thing that's going to happen is you're going to lose your 2%. I think that's a pretty slick deal. I call it the magic of math. Stay with the winners. You got to let them run, right? You got to let them run. Resist jumping out too soon, because what you're doing is pushing the left side of that graph the wrong way. Jumping out of winners too soon skews this thing to the left and dramatically impacts in a negative way that number and that number. Not good. So stay with the winners as long as possible, and then get out of them at the right time, right? Trail your stops using real price action. The trading pyramids are an awesome tool to do that. Then get out, right? Trend's over, get out. All right, Joseph's agreeing. Rookie move to scale in while losing. Yeah, having a lower cost basis is awesome till you lose 10% of your account. Then it doesn't seem like such a good deal. So here's how we trail stops. Right, here's a trade we were in. Vail is an awesome trade, right? We set our initial stop at the pyramid. Price moves up, then we trail it to the next one. We trail it to the next one. We trail it to the next one. Boom, we get stopped out. Trade over. That was wave 3. Perfect wave 4. Hey, here goes wave 5. Right, got a pyramid. Take an entry. Stops here, 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 here. Right, still going on. And at key points, here we are crossing a key Fibonacci line. Got in profit. Reversal bars. Those are good points to take profits and then let this thing run. This would have been a good candidate to scale in, right? We take an entry at the first pyramid. We move our stop here. It's really not a move. Move our stop here. Maybe we move our stop to the bases, right? Here, here, here. At this point, we go, wow, we've got our stop here. It's still a long way to go to the target. I'm going to add to this position. I can do it without increasing my risk. Beautiful. All right. Let me show you a couple of my current favorite charts, and then I will be happy to take a look at some that you're interested in. So, where's my platform? So I showed you Halliburton. I like it. It's a classic wave 5 high probability trade. I think you could take it now. Stops down here about 48.01. Got a target up here. Super trade. Oh, I was going to show you before we start looking at your symbols. I want to talk to you about the magic of options, right? Or some cool math about options. So I know there's a thousand ways to trade options, and they can be complex. And I like things to be simple, right? The most profitable option strategy for a directional trade. This is a swing trade. It's a directional trade, right? We have a high probability belief that Halliburton's going to go up to this target zone. It's directional, right? The most profitable option play, period, is to go long the calls. A lot of people like to go do spreads and diagonals and winged creatures, butterflies and condors and all that kind of stuff. There's a place for all those strategies. But a strong swing move directionally with a high probability outcome, if you have any of the option search tools, you go, hey, for Halliburton, over the next 60 days, I think it's got a chance of rising 15%. What's the most profitable option play? Those option search tools will return nothing but long call plays. They will not return spreads and anything else. Okay, it's because it's the most profitable. So we look at this and we go Halliburton. Here's the option chain. I like to be, if I take a trade like this, I do not want to be in the option contract during the last 30 days. I expect to be in this trade another month or two. So I think the April is a good contract for getting into it now. And I like to go, and you've heard Bennett say this, I'm sure, many, many times. Yeah, TJ saying at the money or in the money. ITM, baby, deep in the money. What we want is a high delta, deep in the money option contract. I'm going to show you why. And so I like this one. I think it's the 47.5. Yeah. No, 45. 45. It's got a delta. This is such a critical Greek. Delta, 88. Delta is the amount that the option contract price is going to increase for a dollar increase in the underlying shares. And then look here, another number, intrinsic value and extrinsic value. These are super important. So you'll hear some people, some strategy, some educators talking about, well, if you buy, if you buy an option buyer, you're buying premium, right? Buying implied volatility. Really? Depends on which one you buy. Let's go look at another spreadsheet that I built. Here we go. So here's Halliburton, April 18. I've got two of them. Here's the one I like, the $45 call, which is deep in the money. In the money means Halliburton's trading at $52, right? So the strike price is well below current price. It is in the money. Let's consider an out of the money contract at 57.5. Okay. So 45 in the money, 57.5 out of the money. So there's two components to option pricing. There is intrinsic value and there is extrinsic value. Intrinsic is kind of like if you have a silver dollar, right? How much is a silver dollar worth? Forever, regardless, non-arguable, it's always worth $1, right? Now, if it's a collector piece, special silver dollar, it may be worth more money than $1 to collectors based on its, vintage and condition and whatever, right? But that's extrinsic. Right? Intrinsic is it's always worth $1, right? And so that's the same thing with option contracts, right? A deep in the money call contract has intrinsic value. In fact, this $45 call, 94% of its value is intrinsic, meaning I can exercise this contract, right? $45 strike call gives me the right to go buy Halliburton at $45. And since it is $7.85 in the money, right, it is worth $7.85 because I can go buy Halliburton at $45, right? And there's a 6% extrinsic, which is based on volatility and the time remaining on the contract. Okay, the 57.50 has zero intrinsic value because there's no value in going and being able to go buy Halliburton at 57.50 when it's trading at what is it, 52 bucks, right? That has no intrinsic value. Now it may go up. So the price of those contracts is $102, right? $102 because maybe it'll go up and we think it will. And so you'll get lucky, right? But it has no intrinsic value today, right? The $45 call has $785 of intrinsic value. It's only got 50 bucks of extrinsic value. You're going to pay 835 bucks for that one. You're going to pay 100 bucks for that one. And so some people all the time, they ask me, Dean, why are we buying the expensive contract? Why don't we buy the cheap one? Because the cheap one can be really, really, really expensive, right? Because what we're going to do is we're going to trade a fixed amount of cash. Say we're going to trade $1,000 or we're going to trade $2,000 on this trade. So we can buy one of these, or we can buy 8 of those, right? 800 bucks for that, or 10 of those, or 8 of those for 800 bucks, or 1,600 for 2. You get it, right? But we're going to put a fixed amount of money into the trade. So look at this chart. So delta, right? The amount that the option contract will go up if the underlying price goes up. Right here, I put these two delta values. This one is 84. Notice this one is 26. That's very low. So the price of the option contract is only going to go up 26 bucks if the underlying shares go up $1. The one in the money, if the underlying shares go up $1, this is going to go up 84 cents. And so you can see at underlying share prices, I just increased it by $1 from current price up to hopefully hitting our target. And you can see this graph. The in the money contract is going to be not only significantly more money, but it's look at the slope of the line, right? The amount it increases is dramatically more than the out of the money contract. So if we put the same amount of money on the table, right, $1,000 or $2,000, we're going to make more money with the in the money contract if this thing goes our way. And by the way, if it fails and hits a stop, we're going to lose a lot less with the in the money contract. So that's my little riff on some cool math about in the money, out of the money, and why cheap contracts can be really, really expensive. All right, let me show you another trade I like. I'll just look at the ones that I got open in my trading room. And we've got some nice ones open here. I'm in Halliburton. I'm in Whiting Petro. We just got into Whiting Petro. It's a phenomenal trade. It's got huge potential. Look at this huge drop here, right? This is massive. So we're either going to have a retracement to that, right, which would be take us to levels that we would have a hard time actually believing, up to 80 bucks at a midpoint, right? Or this is a new trend forming. But what we got is nothing but green on the Traders Coach tools here, right? We got green pyramids, we got a green L, we got a green PTF, right? And either it's going to retrace or it's a new trend. Either one of those is a really good situation. And you got a place to put a stop, you got a place for an entry, and you can figure out a target either into this retracement zone or, at previous highs. Either way, the reward to risk ratio is outstanding on WLL. Let's look at another one just for fun. British Tobacco, ETI. Wave 5, long trade, pretty clear. There's 3, 4, 5. It's getting a little late on this one. Target zone is up there. My trade station's a little slow up there. So above 72.77. So there we go. There's 3. That was a little. I better give you another one because I only gave you 2. I gave you Halliburton and WLL, both energy related. Valiant. There you go. Valiant looks awesome. So look at this big drop on Valiant. You have to blow this up to even see what's going on with current price, right? But it is rocking up off the bottom here and looking really, really good. There we go. Breaking up out of this channel, we got a green pyramid, we got a green owl. We're yellow, so we're neutral here. And this thing could just go to the absolute moon. So I like that one. So there's some trade ideas. So what charts would you like to look at? I'll look at a couple for you guys. Give me my. Do I ever look at option charts? No, TJ. I look at the stock charts and then I choose the best option play based on my trade parameters on the stock chart. All right, so Rod wants to look at XAU and then the US dollar. And I hope this platform, XAU, did I do it right? XAU. I don't have data for that. I'm not sure what it is. USD, I think this is the US dollar ETF. Oh no, ultra semiconductors. Teach me to guess. Okay, USD, ultra semiconductors. This looks like every semiconductor chart you're going to look at. This looks just like a Micron. This looks just like Applied Materials, right? Big run up. November had a little pullback, and now we're putting in new highs. Oh, you wanted a pair. Okay, you wanted XAU USD. Got it. Now I got it. XAU USD. Yeah, that didn't come up either. I'm sorry. Okay, well anyway, USD, my point there was too late to enter, right? We missed it. Freeport McMillan for Al. Yeah, it's in a nice uptrend. It took out this previous high. It's not my favorite chart. I like to catch them early, and we're a little late, right? We're a little late to the party on this one. Taking out that last high would have been a good entry, 17 bucks. You know, we're above that, and there's not really a clear wave pattern here, so I'm not a fan. And you know, the odds are that most of the charts that come up, just based on my experience with statistics and the number of charts and the number of good ones I find, um, uh, I look at 10 to 15 charts to find 1 to 2 that I like. So that just means 80, 90% of the charts I look at aren't going to have the pattern I'm looking for. Because again, I want a high probability. There's all kinds of ways to trade the market. There's all kinds of indicators, and there's a lot of systems at work, right? I use a system very similar to Bennett's. You know, I'm using Elliott Wave. I'm using the ART tools. I have Ichimoku Cloud here, right? And I'm looking for a wave 3 breakout, wave 4 correction, or a wave 5 continuation. And if I don't see one of those setups, I'm not really that interested in the chart. There may be other ways to trade it. So, you know, it's just like, you know, if you're into horses, right? Maybe you're into team roping. So go, what do you think of this English saddle? Oh, it's beautiful, but it's completely unsuitable to my needs. So that's the deal. So I don't want to sound like a drag, right? But I'm looking for a very specific pattern that I have a high probability on, and that's what I'm looking for. If I don't see it, I'm just going to move on. That's almost there. Global uranium. There was big 3 down. It already did a 4, and then it kind of had a failed 5. So this could be a new trend forming over here. I would not try to short it. I would look for it to reverse and then continue up. And if we can get a pyramid or a good entry above this previous high, there may be a new trend coming up here, but that's premature. It's not there. Yeah. Do I use the ART scanner, TJ? Yeah, absolutely I do. Absolutely I do. Got the ART scanner, the turbo scanner, and there's one more. There's 3 scan tools. I got them all. STM for Dave. Yeah, I mean, remember I said when we looked at, by mistake, but we looked at USD, a semiconductor ETF, and I said pretty much every semiconductor chart's going to look just like that. Here it is, it looks just like that. And it's going to be the same answer on every single one. Beautiful trend. Would have liked to get into it back here. It is way too late for me to try and catch this trend, and it's way too early to try and short it. There's no signs of bearishness yet, unfortunately. I got a watch list item here I'll show you for fun. You're gonna laugh, right? But if we win, you won't laugh. So Rite Aid, RAD. A stupendously lousy shopping experience if you've ever been in a Rite Aid store. But this chart, I mean, this thing's been crushed. Look at this wave 3 move, and look how it's beginning to show real signs coming up off this bottom. This is a low price thing, right? Man, we got these pyramids down here. We're green. We got a target zone at about $5. That thing could double, and it trades at massive volume. There's a very liquid market. There's options if you like that, right? I'm looking for it to take out this high. If it can get to 275, I'm a player. I'm in this thing. I think it's got a really good chance. And I'm a technical trader. I could care less about their business model. They may be going out of business next year. I don't care. For now, there's a clear, corrective wave set up here that could take us up to $5 before it then turns and goes back down to zero. So I like that one. Any others that you guys would like to look at? There we go. IMGN for Naga. That's interesting. So you got the big move down. Let's see if it already retraced to its wave 4 target. It did. Yeah, it did retrace to a wave 4 target. Looked like wave 5 was going to be a go there, but it failed. See, it started to head back down again. And now it's heading up. So this could be just a very complex correction. The next move here is going to be down, but on these lower priced ones at this low price too, it probably ain't going to zero. So, maybe there's a new trend. I would wait and see if there's a 3, 4, and then maybe get a 5. So you have to wait on this to go long. So nothing right now for me. Wow, look at the time. I want to be respectful of time, and I want to wrap this up pretty close to an hour. So I'm gonna. That was fun. We didn't find any new ones, but I gave you some ideas. Hopefully you found those useful. Okay. So again, let's just recap here. I think in order to be the house, in order to have consistent profitability, to be working like the model I showed you, where we don't know exactly what our win rate or our payout ratio or our profitability over the next 50 trades is going to be, but for it to be positive and to be within some acceptable range, got to have great trade setups with high probability outcomes, great reward to risk ratio, risk management, trade management. Do you guys believe that? You guys agree with those statements? Just curious. Raise your hand. I think there's a raise your hand button somewhere on the platform here. Little hand icon. Absolutely. Definitely. Good. Okay. What happened? Wow. I obviously pressed the wrong button. So, do you feel like this guy, right? Maybe. I just presented a lot of information, right? A lot of information, and went over some trades really quickly and all that stuff. So if you don't mind, I'll just spend a few minutes and I'll just go over a special offer that I got here where I can help you out if you're interested in it, right? Again, I teach and provide great trade setups, risk management, trade management, right? And what would that be worth if you had somebody basically, sitting there with you side by side, looking over your shoulder, helping you, guiding you to get winning picks, right? My winning picks last year for the pick service, on a $100,000 account, it was about $1,900 a month on average. If you were to get 4 hours of detailed trade consultation every month, one-on-one consultation, ongoing education, that's going to cost you a lot of money at any provider, right? That's going to cost you probably $5,000 or more. Well, I'm going to offer you all these 3 things: great trade setups, risk management, trade management, ongoing support, training, and it's not going to cost you $5,000 either. So what I'll do, I got 2 offers. Some people really like my live trading room. We're there Monday through Thursday. Unless there's a holiday like this week, then we're there until Friday. Hour and a half in the morning. We're looking at the markets, looking for good trades. I showed my, so in the live trading room, we currently have, 9 open positions. 7 of them are in profit, right? Because our model's working. Again, we're there an hour and a half in the morning. We find good trades. It's a great community. People answer each other's questions. The traders in the room, you're able to chat. people on different platforms, TOS, TradeStation, whatever, and they help each other out. And I answer questions. We analyze charts and find great trades and then manage them. We're not day trading. We're in the trades a couple weeks to, maybe a month, month and a half on average. And if you're not available in the morning, it's 6:15 a.m. Pacific to 7:45. That would be 9:15 to 10:45 Eastern, hour and a half each day. If you're not available, that's all right. Try my stock and option picks, right, where I send you great trades, text message, email alert, posted on our website. And we have a live chat session every week. In fact, it's tonight at 6 o'clock. So if you sign up for this, you can join the live chat session tonight. We're going to be going over the current trades. You get, like I said, email, text alerts, all that stuff. So let me get you the links. Right? I'm saying you're talking about this and you're not able to go find out more. So for the 7-day, 1 week, $7 trial, here's the link for the live trading room. You can check it out. Come check it out for a week for $7. Or if you can't make it to that, you just want to join the pick service, then that's $37 for a full month. Right? With the pick service, it's going to take a month to really get a good handle on what we're doing there. So you can click on those links, or you can just text trial to this number, 360-310-4171, and the links will come to your phone, and you can totally check it out and place orders and do all that on the phone. Do I do Forex, Rod? No, stocks and options. Larry, will there be a recording? I believe Gene will be sending a recording out for everybody who registered. I don't do Forex. I focus on stocks and options. And Jerry's asking if a long in-the-money call option is most profitable option trade for a directional trade, Jerry. So that's an important qualifier. For a bullish directional trade, a long in-the-money call is the most profitable. For a bearish directional trade, a long in-the-money put option is the most profitable. Trading room, Michelle, 9:15 to 10:45 a.m. Eastern, 6:15 to 7:45 Pacific, Monday through Thursday, except on holiday weeks like this week. So we're doing it Tuesday through Friday. So we'll be there tomorrow morning and Friday morning. You can join and be there in the morning with us. Rod, is gold a stock? Gold's a commodity, but there are several stock or stock-like things you can trade for gold. There's gold futures, right? And then there's gold ETFs like GLD, and then there's gold miners ETF like GDX, and there are individual gold stocks, which don't move perfectly with the price of gold. So there's a lot of ways to trade gold with stocks and options. Short answer. Ron, if my service does both stocks and options, how do you know if I'm trading a stock or option on my personal account? For the stock pick service, when I take a trade, I just, people have been asking that a lot, so I just declare up front where if I'm trading with shares or with options. Right? I provide the information so that people can trade it either way. Some people prefer options, some people prefer shares, so I provide the data to trade it either way, and I make it clear which way I'm going to do it for an individual trade. My preference is always options, unless there's some reason, right? Some reason to push me towards shares, but I really like trading with options. So I think there's some more information here. Yeah, so the live trading room, it's $7 for a week. After that, it's $59 a month. That's a discount. Again, here's the times, and you can click on that link that I posted, or just text trial to 360. Don't put quotes on it. Trial to 360-310-4171. Stock and option picks, 30 days. If you sign up for that, you get a one-on-one consultation with me. You'll get an opportunity to schedule that if you choose, weekly chat session, and winning trades. And after 30 days, that's $97 a month, which is a 25% discount from the list price on the website of $127, right? So there you go. Either one. Yeah, well, thank you. It's been an honor to come present. It seems like you guys, I hope you found that information useful, that's something you can apply in your trading. Sure appreciate your attention, and thank you, Gene, and traderscoach.com for inviting me back again. I always enjoy presenting here. So I think I'll go ahead and turn it over back to you, Gene.
Dean, that was great. Always good to have you on Wednesday Night Live. And boy, the attendees really participated a lot tonight. So that was really, really productive. So anyway, I encourage you all to check out Dean's trading room and his picks. Also, too, this event is being recorded, and I just posted in the chat area the link where you can access the recording in our archive area. It will be available tomorrow morning. And everybody, yes, Larry, good to see you here. And everybody, thanks so much for joining us tonight. And I know Chandra's here from far away. Good to see you. And a lot of other folks from far away. Good to see you all. And thank you for joining us. So everybody have a great night, and we'll see you next Wednesday for Wednesday Night Live. Have a great night.